Good afternoon or good morning everybody, depending where you are in Australia. My name's Trevor Monaghan. Today I'll be taking you through the content about business valuations from a family law perspective. And today's session is just for solicitors to gain a better understanding of how they can help their clients by knowing just a bit more about business valuations, from being a fly on the wall in an office of someone like mine that spends all day doing business valuations. And from a legal point of view, understanding and what does that mean, and how can you then, knowing what the business value actually does, be a more useful contributor in the process to get a better outcome for your client. So welcome everybody. We've got a number of firms on today's call. First thing I'll get everybody to do, so we are handing out CPD or CPL certificates of attendance for the 1 hour session today. So that we can give one to everybody attending, could you type in the first name and last name of everybody attending at your office? You can do it in the questions panel over on the right hand side. We do that because we know we have a number of firms who have multiple people watching on the one screen, only registered under one user. So if we could just get everybody's first name and last name, that way we can make sure everybody gets their own individual certificate. Fantastic. So again, even if it's just you, just yourself, if there's multiple people in the room, put down each person. So just while you're doing that, I'll introduce myself. So again, I'm Trevor Monaghan. I'm a chartered accountant, and I spend most of my day valuing businesses. We'll talk why that's important to know in a minute. Let's get moving. So what are we going to talk about today? Well, today, as I said, it's not about me learning something. I already sort of know this stuff. It's about you as a solicitor working in family law and working in any other case that involves a business valuation, understanding just enough to have those informed conversations with your clients, with the valuer and with the parties on the other side. So in my experience working very closely in the last couple of years with solicitors on family law matters, I'm just getting the feeling that solicitors aren't engaging in the process at all, to the point where they hand over information, they ask for a report back, they receive the report, they look for the number on it, they basically then put that in the drawer or send it to the other side. Don't really have an opinion on that outcome. I ran a face-to-face session in Sydney for a group of lawyers only last week, and we sort of had a joke about, does anybody actually ever read a report front to back? And sort of nobody. And does anybody ever read beyond just what the executive summary says? And again, pretty much nobody. So a lot of the goodies in a report are not in the number, but in the language and the qualifications and limitations around what are the things that the valuer wasn't so certain about. Because at the end of the day, there's no point arguing about facts, but most of the valuation assumptions that we use and the methods we use aren't based on facts, but based on our opinions, based on assumptions. So as a lawyer, it's your job, to work out what you agree with and what you don't, and you're certainly entitled to have an opinion. In fact, a good valuer encourages opinions. But again, I think there's too much of a sort of a feeling of overwhelm when solicitors start reading these reports. They just think, well, where do I start? Let's just accept it and move on. We'll talk a bit later about a situation I've actually had this morning with a solicitor, and it's just a case in point where you can't take a valuation at face value. So the idea, after today's session, every solicitor on this session should be able to walk away and have that 1 minute conversation that's an intelligent conversation with somebody else about valuing businesses. So you don't need to be a business valuer. So we're not certainly suggesting you have to be an accountant or understand the science. You just have to know how to have an intelligent conversation and know what questions to ask. So if a client comes into you and says, do you do divorces? You say, yep, of course we do. It's on our brochure here. And they say, great, do you do businesses involved in divorces? You're going to say, yep, sure. And they say, well, good, because I've got this issue here. My spouse hasn't been declaring his income, or yada, yada, yada. There's all these specific circumstances. And then what they're wanting is just for you to sort of respond in a way that makes it sound like they're in the right place. But I think what's happening too often is solicitors are sort of responding to those questions with a blank stare. And again, it's just about, what is that 30-second conversation you can have with your client or prospect that makes them feel like they're in the right place. It's certainly going to help you to be able to help your client later on. We're going to talk about what information is needed to value a business. It's different for every business, but once you sort of understand what our process is, you can start getting a feel for exactly what we might need. What makes a business worth something, and unfortunately it's not as simple as just tell me what it's worth. We'll have to talk a little bit about what that means. How to value a business for family law specifically. If you've ever been involved in a family law case with a business valuation, you'll know that the family law courts tend to take a different view to the rest of the world about these things. Often we've got to an extent, throw the textbook out the window and use a method that the court requires, and often there's no consistency amongst different cases or different courts, and often it is in a situation where everybody can agree the commercial value of something is X, where we're asked to value it under a very specific way for family law where the outcome is Y, which has no regard to market value, but at the same time everybody's okay that that's the case. So again, if you don't understand the difference between market value and what the family law court wants, then you're going to be at a disadvantage, certainly if the other side understands that. We're going to talk about the three options that I provide for valuing businesses and why I don't think you need to spend a lot of money all the time. We're quite happy to take your money if you want to throw it at us, but I just don't believe in a lot of cases, especially if there's small asset pools, that you need to spend more than a couple of $1,000s to get a very good valuation result. When I say a good result, I'm not talking about in your favour, I'm talking about the truth, but at least, not doing any more work or paying for any more work than you actually have to. At the end of the day, there's some jobs where it doesn't matter how much time you spend on the valuation process, you're not going to get the perfect result because there is no such thing. So it's a matter of how can we do it in a cost-effective manner so your client doesn't have to spend any more to get the thing valued, understand what the assumptions are, and move on. Because obviously this isn't usually the only thing being argued about in a case. So we don't want to spend all your client's money just on this. We'll talk also about the top 10 mistakes that we see when being engaged by solicitors as the valuer. And I guess from your point of view, you can see that as the top 10 opportunities to provide effectively a better service to your client by being more, and again, some of the things I'm saying are probably coming at condescending, and they're not meant to be, but being more of a useful participant in the process before, during, and after the valuation is done, so that, again, you're not trying to persuade anybody of anything but the truth, but sometimes the truth isn't self-evident, so the valuer needs a bit of assistance coming up with that truth. I guess that's the best way to put it. And also questions. So if at any time during this session you do want to ask a question, obviously you've got to be on the live webinar. If you're watching this as a recorded video, you've sort of missed out, but if you are on the live webinar, just type it into your questions panel. I'm the only one that sees the question, so don't be worried about any confidentiality or being embarrassed about asking dumb questions. I'm the only one that knows that, and we'll definitely cover that in the session if it's relevant. So now this is a really important section. Who I am, not to say, not to brag about who I am, but there's two types of valuers. There's the valuers that come from the finance background, so they're generally chartered accountants or certified practicing accountants. They're the main two accounting bodies in Australia. I'm going to say the chartered accountants are the best, and probably the CPA is going to say the other, but probably to an extent pretty similar. And to give you an idea, what is our background? We generally we go through a traineeship, and we do a couple of degrees, and we go through a traineeship, learn how to create financial information. We prepare financial reports, tax returns, that kind of stuff. Advise businesses on growing their business and marketing, buying, selling businesses, capital gains tax, all that kind of stuff. And from that, a very small subset of those types of accountants go on and actually offer valuation services using all those skills that we've picked up over the last decade or so, and applying that into what does that really mean for what a particular business is worth. And you do, in my opinion, you do have to have that depth of different types of skills and experiences to be able to even start thinking about valuing a business. So as you can see there, part of the special interest group with the Institute of Chartered Accountants, only a very small number of accountants are actual valuers. I'm also a business broker, not that I offer that service to the public, but just to let you know I do have that qualification. I'm also a tax agent, I've got the usual couple of degrees. Now it's important, not to brag, but the other type of values that come across in the situation I'll talk about we've had this morning, people that come from basically a property background generally. So they might have been a real estate agent or a property valuer, and from that then extended into offering business valuation services. And that's fine if the engagement is all about what would this business sell for if listed by a business broker in an active market. But almost on every occasion for a family law case, especially for a small business, that is not a relevant consideration to any meaningful extent. So we'll have situations often where everybody agrees that the market value of the business is nothing and it's unsellable, but it doesn't mean it's worth nothing for a family law context. So the situation that's come to us today, another valuer had charged, I think it was about $3,500–4,000 to do a basic valuation. They weren't accountants. They were from a property industry. They had a business valuation certificate from a property valuation organisation, which probably doesn't carry much weight. And effectively what they've done, they've said, okay, this business is worth nothing because we don't think we could sell it. and fair enough. This is for a family law case specifically, and that was what the court order has asked for. And then they've come up and said, well, and let's just look quickly at the value of the equipment, and therefore the value of this whole thing is, say, $30,000. That's the value of the equipment. And that's fine on the face of it, because if it's worth nothing, well, okay, if we sell the equipment, what could we get for it? That makes sense. But the problem was, which they should have been aware of, is there's a balance sheet for that business. And if you're not an accountant and you haven't seen a balance sheet before, all it really is a photograph at a point in time of everything the company or the entity, it could be a trust or a partnership, anything this entity owns in terms of money in the bank, assets, money owing to it, less any debts, which could be trade creditors, GST, bank loans, that kind of stuff. So the assumption is that if we shut down this business, we can call in those assets, turn them into cash, pay out the liabilities, and there may or may not be something left over. In this case here, there was $34,000 in the bank. There was about $55,000 in accounts receivables, and about $30,000 in equipment, which they'd mentioned, and about $20,000 in debts, credit cards and ATO and that kind of stuff. And effectively what they've done, they've ignored the cash at bank and the accounts receivable and the other debts, and just gone with the value of the equipment and said that's what the business is worth, or the entity's worth, which just obviously doesn't make any sense, because if someone was to take control of that business at that date, they control that money, they control the accounts receivable, assuming there's no bad debts in those accounts receivable. So a very simple thing. In about 5 minutes, I was able to go back to the solicitor who had given it to me for my 5-minute free advice, and have come back and said, look, they've put it at $30,000. It's obviously worth at least 80, 85, and probably worth more. So it's an obvious thing that, and again, the only reason that this report has been critiqued is two people actually from this firm have been to one of these webinars before, and they knew the questions to ask, they knew the things to look for, and it just didn't make sense to them. And often, even though you don't have a finance background being a solicitor, sometimes you read things that just don't make sense, and sometimes your gut is right, and in this case here, it just doesn't make any sense. So they're just going to go back to the valuing and have it please explain. But if they hadn't have done that, it would have gone in, value the business $30,000, spouse's half, assuming 50-50 means $15,000, when really it should probably be more $40,000 to $50,000. So straight away, that solicitor has added value to their client, probably at least $30,000, just because they knew what questions to ask, they knew it didn't look right. Where most solicitors, in my experience, would have just accepted the valuer's opinion and moved on, gone and argued about the custody issues and all the other stuff, which are important, but there's money to be made and saved in the valuation issue. So again, that's just in around the whole area of, well, what's the valuer's background. This particular valuer probably didn't understand what a balance sheet was. In this case here, the balance sheet ended up being the only critical thing to worry about in the valuation. And because they didn't, to be honest, they were incompetent, didn't really understand what they were doing, it took the solicitor to come back and identify that, which is, in my opinion, dangerous. But it is what it is, and as a solicitor, it's your job to ask those questions. So let's move on. So what makes a business worth something? Well, unfortunately, there's no universal definition. You'll hear the definitions about, what a knowledgeable and willing but not anxious seller and a knowledgeable, willing, and not anxious buyer with, full information would agree at arm's length, if neither were compelled to act. You see all different variations of that definition, but it's pretty similar across the board. But basically what it says is that we've got this hypothetical buyer. Now what does that mean? Who is this buyer? Does there need to be a buyer? Does there need to be an active market? And generally for a market valuation, it depends. Sometimes we'll do this hypothetical nameless, faceless buyer, and sometimes we'll look at it from a particular buyer's point of view. But in the family law case, sometimes we'll get to a situation where we can all agree there are no buyers, and we will change our definition of value. So it's really important not just to think there's one definition of value and just go, well, this is how I've seen it defined somewhere else, so this is how it must apply in all cases. It's certainly not the case, and certainly not for family law. When we're talking about value, what does that mean? Do we get value in using something, or do we get value in owning something? So if we own Telstra shares or BHP shares, we only really get value in ownership. We get dividends and maybe some capital gains because we own the shares. But the fact that we own them, we don't really use these shares. They're a bit of paper. They don't really give us any other benefits. But as contrast to a small business where we're living, breathing that business, we get to tell people we're an entrepreneur. People will pay for that, pay premium to be able to do that. You get a bit of maybe time flexibility being your own boss. You get some fringe benefits, which may be financial or non-financial benefits. So you've got all these extra value in use that you don't get in ownership. And again, it's really relevant for a lot of small businesses. A lot of closely held family businesses where you get these other benefits that aren't self-evident from the financial reports. And a really interesting concept is the value of, well, it's all about perspective. Is it the value to you or the versus the value to somebody else? So is there such a thing as value, or does it depend from whose perspective? So the classic example we use is a pair of reading glasses, so spectacles, prescription glasses. So they're owned by John Smith, and let's have them forensically tested. They're 250 grams, they've got a certain metallic composition in the frame, they're a certain colour, and the lens is a certain prescription. So we can go and have that forensically tested by a third party, and all parties can agree on what the glasses actually are, when they were manufactured, what they weigh, everything. They can forensically test it, and no one can argue about the tangible nature of it. But then we go a step further and go, okay, John Smith, what are they worth to you? And he says, well, I need these glasses to drive at night, otherwise I can't go and visit my girlfriend, and then basically I don't have a life. So he would say they're absolutely invaluable to him. But his next door neighbour, Sam Simon, he also needs glasses to drive at night, but these glasses don't suit his eyes, and the prescription lenses aren't interchangeable. So he would say, I don't disagree with the tangible nature of the glasses, and I don't disagree they're worth something to my next door neighbour, but to me they're worthless. So in effect, if he had to come up with a figure he'd pay for them, he wouldn't pay anything for them. So this is a classic thing that we come across all the time, is that yes, you can establish that it's worth something to somebody, but does that mean it's worth something to me, or the perspective I'm looking for? And what about if we're looking at a nameless, faceless, massive, hypothetical potential buyers? From whose perspective we're looking? Are we looking from a strategic buyer that's known, or we're looking from a general average of the marketplace? And again, these things aren't settled. They're not settled in case law and legislation, and every valuer will disagree. So again, it's the kind of things that you have to have an opinion on these things. Every valuer will have their own opinion based on whatever justification they've got. But again, as a solicitor, you are quite entitled to have a totally different opinion. Nobody's necessarily wrong. They're just opinions. So if you know that, and you know enough about what kind of questions to ask, so you're probably already starting to see that there's definitely room for you to have an argument in these things. When I say argument, I'm talking about constructive arguments, getting to what you think the truth is, not trying to argue that the sky's red when it's obviously blue. So an important concept, we need to understand every valuation is about return on investment. If I can't equate something back to return on investment, then it doesn't make any sense in terms of value. But it could be financial and non-financial returns. So it's not as simple as what is the profit compared to the buy price. Because if the example where I've got a small business, I'm getting all these fringe benefits, I get to turn up to work at 10 o'clock because I'm self-employed. Is that worth something? Well, it probably is. I'll probably pay a premium for that, but how do I quantify that? So again, there's different opinions about that, but it still is about a return. You're getting a return of flexibility, not just a return of money. But if you can't equate the value back to a return on the investment, and you're just doing some kind of rough rule of thumb like multiplying the profit by 4 because that's what gets done in the industry, then very easy for a good valuer to just blow that down instantly. Just go, well, what does that mean? How does that equate but to a sufficient return based on the risks? What does that number actually mean? And again, that's what a lot of non-accountants, when you talk about the property valuers, business brokers, other people out there offering services that don't have the finance background, they go and rely on these rule of thumb things that seem to make sense on the surface, but when you say, what does it actually mean? How does that equate back to the specific risks of this business? This business relies a lot on the key owner. How does that factor into that number? Don't just tell me in your judgment. We get a lot of that in our industry where someone will say the multiplier is 3.6 in my judgment, and then you turn to the next page looking for what that judgment's based on. There's nothing else. I'll spend sort of, and hopefully you're smiling and nodding if you've read a lot of reports. You'll see 20 or 30 pages explaining, a couple of key concepts, but the main concept is one sentence that says "in my judgment." And of course, courts don't like, yes, the experts there for their judgment, but you've still got a judgment based on what. And importantly, we need to think about opportunity costs of the alternative. So in economics, nothing's worth, you can't value anything in isolation. It's all about opportunity cost. Because we could find a business generating a certain level of profit for a certain investment amount. We could say, great, that's worth investing in, but at the same time we find another business with a slightly higher level of profit with the same investment amount and the same risks. Everything else being equal, we're going to invest in the second one and not the first. So even though the first is worth something in isolation, because of the opportunity cost of alternatives, it's actually worth nothing to us, assuming we could only buy one of the businesses. So again, there are no formulas for this. There's no rules. There's no legislation or case law. It's just about having a bit of common sense in all the circumstances. And again, there's so much judgment and assumptions we have to use as a valuer. And again, there's people out there that have this automated software where you put a few things in, it spits out a valuation report, dangerous stuff, and that kind of software is actually promoted. And I had a salesperson come to me and say, Trevor, the good news is you can have your receptionist do your valuations with software. It's so easy. My knees tremble going, my God. Trust me, I've tried to make software that automates. It's not possible. You have to use judgment at every level. So obviously we're looking at then return on investment versus those opportunity costs. So a couple of key things. Yes, there's a bit of jargon here, but it's not. I don't think it's overwhelming jargon. What is the return to me? I only care about money and other non-financial things that have got value. What am I getting back for what I'm being asked to put in? Now, it's a question I put to people: financial investment versus business investment. Is there a difference? Is there a difference between investing in a term deposit as against to investing in a business? And the answer is no. At the fundamental level, what are we doing? We're putting money down on an expectation of getting money back. There's some differences about, are we actually going to get money back because there's risks involved and all that kind of stuff. And that's true, but on a fundamental basis, the calculations are actually exactly the same. So let's do that now. So again, one of the reasons I think a lot of solicitors are overwhelmed by valuations because accountants and valuers, and I don't know if they do it deliberately. I suspect sometimes they do it deliberately, but often we make the report so hard to read and follow, we're sort of hoping that no one critiques it. When I say we, I'm not saying me, I'm saying us as an industry. So let's break it down and make it sort of Year 7 mathematics. So everybody understands a term deposit. So we've found $100,000 under the mattress, we've gone down to the bank, and we've said, Mr. or Mrs. Banker, I'd like to give this money. They said, great, if you give us that money, we'll give you back a return. In this case, they're giving it back, they're calling it interest, but it's just a return, and they're saying, we'll give you $6,000 at the end of the year for every year you keep that money with us. So we all understand that, and it's interest. It's a basic return. How do we calculate the rate of return? Everyone knows how to do that. 6,000 divided by 100,000 is 0.06, which as a percentage is 6%. So, everybody understand that. It's hard to know whether everybody's nodding because it's a webinar. I'll assume you are. So if we then extend that to a business and think, okay, well, it's exactly the same, except what we call the return is different. So we've found the $100,000 under the mattress, or we've borrowed it from a relative, or we've borrowed it from the bank. We've handed it over to somebody. We've bought their business, or we've bought equipment to start a business, or we've bought into a franchise. It doesn't matter what we've done, but we're minus $100,000, and we have an expectation of having $6,000 back. So importantly, the thing to understand, the past is irrelevant. It's about the expectation. And no, we don't know what the profit's going to be, but that's the nature of the beast. We have to have an estimate or an expectation. It's the same with interest. There's every chance, well, a small chance in Australia that the bank could fall over. You don't get any interest. So there's no such thing as a guarantee. It's the same with the business. No such thing as a guarantee, but we're expecting to get $6,000 back. To make the numbers easy, we expect at the end of the year we're going to get $6,000 back, even though we do know we get that during the year. But to make the numbers easy, we do at the end of the year, and very simply, 6,000 on 100,000 is 6% return. So again, if you're not sure, type a question into your questions panel there. Put a question mark if you want me to go over it again. But at the basic level, a business is no different to a term deposit, and this is how it all has to be brought back. And again, if people are using methods or explanations that don't bring it back to how much am I putting in, what return am I getting or expecting to get, and how does that equate to a rate of return, if they're not having that conversation, or they can't explain how their numbers relate to that, then it's something that we can very easily shoot down and say, well, hang on, it just doesn't make any sense. That's not how an investor would look at it. So if we work backwards, this is where we'll talk about capitalisation rates. And again, people like to think capitalisation rate is something you get from the marketplace. But intrinsically, all it really is turning the rate of return into a number that we can use to capitalise the profit. So again, that's a lot of jargon. What are we doing? Well, if we didn't know how much to invest, so we didn't know the $100,000, we only knew the $6,000 and the 6%. Is there enough information there to work out how much to invest? And the answer is there is. So again, the big assumption here is we're assuming no growth. So we're assuming every year it gives us back $6,000. If we know the rate of return that they were offering or that we wanted was 6%, down the bottom you can see a very simple formula. So we're working out the capitalisation rate. We know that 6% as a decimal is 0.06. All we're doing is, what we'd say is we're putting that upside down on a calculator. So we're doing 1 divided by 0.06. So very simple, get out your calculator. 1 divided by 0.06 gives us a number, in this case it's 16.67. That's our capitalisation rate. So again, all that is working out what is the rate of return as a percentage you would expect on this kind of investment. Putting 1 over that as a decimal gives us a big number, so in this case 16 times, 16.67. Now we know that's the multiplier. So if we multiply that by the actual dollar figure of the return we're expecting, 6,000, that'll tell us $100,000. So again, the thing is, the problem with a business, if we could look at the right-hand column, we know the $6,000, we've worked that out, we've done some expectations, and we know we want a 6% return. That number's not right, but we'll talk about that in a minute. But assuming we did, we could go, well, we know that's 1 divided by 6% is 16.67, right? Multiply 6,000 by 16.67. I should invest $100,000 in this business. And to test it, if we did invest $100,000 and got the $6,000 each year, is that 6%? Yes, it is. So again, you need to, print this out, put it up on the wall. As an aside, we will email everybody a copy of the slides as PDFs, so don't worry about writing all this stuff down. Apologise, I haven't said that from the start in case anyone's making all these notes as quick as they can. You will get a copy. But this is the kind of thing that it always has to come back to this. What is the expected return? What is the rate of return required? Okay, so if you're going to argue about things, they're the things to argue about. Unfortunately, though, with a business, we need higher than 6% because 6% is sort of what we'd call sort of the risk-free rate, or it's approaching the risk-free rate. It's like we know we're going to get the money back, so we're not really worried about risk, but we want to cover ourselves for inflation and a basic return. That's 6%. But for a business, we might want 30% or higher. In some cases, we might want 100% return. Why is that? That's because there's every chance this business could fall over. We don't get the return. We don't even get the capital back. So if we want a 30% return, again, looking at what does that mean in terms of the capitalization rate, very simply, and again, assuming no growth, but it's 1 divided by 0.3 gives us 3.33. Now we just need to know that multiply the 6,000 by 3.33 tells us invest $20,000. Again, we can test going backwards. If we invest $20,000 and get $6,000 back each year, is that 30% return? Yes, it is. Away we go. So interestingly here, the main takeaway here is that the profits haven't changed. It's $6,000 interest or $6,000 net profit, but I'm going to invest either $100,000 or $20,000 based on risk, okay, because it's a different return. So importantly, this could be two businesses. Just because they're making the same profit doesn't mean they're worth the same thing. So again, a lot of people try to value businesses just by looking at the financial returns or the tax returns. Very, very dangerous because that's only telling you half the story. We haven't yet analysed the risks involved, and we need to know those risks to work out how much a return an investor would want. So look at a slightly different way. So if we're still happy to invest $100,000, but we wanted that 30% return, we'd actually have to find a business that we expect to generate $30,000 profit. So we're not saying we're not going to invest $100,000 in a business. We're just saying we need to find a business that's generating $30,000. Otherwise, we'll put our money in a term deposit, and we're happy to get the $6,000. But we're happy to do that because there's much less risk. Okay, so there's a lot of stuff going on here with risk. So if I do a bit of a matrix here, so this is a very interesting thing that I like to show to people when thinking out loud with them about what could this business be worth. So there's really two axes here. We need to think about what is the ongoing profit, and again, it's a future profit, and really it's a future cash flow. So what is the cash that we're going to get back from this business year on year? That's across the top. And down the left, we're thinking what rate of return do we need to invest in a business with this risk profile as we see it. So the top left-hand corner, it's a business we think is going to generate $50,000 being very low risk. Happy to get a 10% return. That business will be worth $500,000. Go down that column to $50,000. That basically means we still think it's going to make $50,000, but we want a 100% return. So we can go across from different levels of profit, different levels of risk, and that will give you different ways the business could be valued. So this particular business could be valued anywhere from $50,000 up to $2 million based on how we assess the profits and the risk going forward. And again, it is a going forward thing, and that's why there's a lot of subjectivity involved. It's not just about what it made last year. Okay, so we know it's all about perceived risk. We know higher risk means higher required rate of return. And we know higher risk means therefore lower business value, because higher rate of return means lower capitalization rate. And we know that different buyers perceive risk differently. So you can see in here, valuers have to pull their hair out as they're trying to work out based on their judgment. How is this business, how is the risk structure different to other businesses? So assuming we can get some kind of market data about what other businesses sold for, it's not enough. We still need to look at what is the risk profile of each business compared to each other, which is often impossible in a small business context. So what I'm showing you here is a bit of a cheat sheet of some of the main things that we argue about, and as an extension of that, lawyers should be arguing about when we're assessing the value of a business. So to give you an idea, so you might say, well, how do we argue about these things? Well, when I do a valuation, the first thing I do, once we've been engaged and sorted out the fee structure and everything, I issue a questionnaire. So the questionnaire very clearly asks lots of questions about the business that aren't self-evident from the figures. So this is an opportunity for solicitors to become involved. So if you think it's in your client's interest to instruct the valuer and inform us about how much the business relies on the key people, whether that's the owner or other key staff, or anything to do with risk or anything to do with the figures, you have an opportunity to provide information, to tell a story, provide facts, or assertions to the valuer, and don't worry about the valuer being independent or not independent. If it's a joint engagement, I give both parties equal opportunity to provide me that information. If it's a one-party engagement, then at the very, very minimal, one party offers their opinion, the other party is willing to if that party wants them to. But don't worry about, I guess, the level of evidence that a valuer can accept is much lower than what you need for a court. So our job is not to provide a judgment based on the facts. Our job is to use our judgment in a different way than the court's judgment, but to use our own our own subjective view based on information that we can see, whether or not we can verify that information. Obviously, information we can verify is worth more than information we can't. But just because something can't be 100% verified doesn't mean we can't use it in some way in the valuation report. So don't worry that what you've got is only a story. That's fine if you've got some kind of reason that you believe it's more than a story, but you don't know for sure it's a fact, then it doesn't stop you providing that to the valuer. Let us to decide what we accept and what we don't. Again, so I have a lot of issues where solicitors don't think they've actually got a right to provide anything other than facts. That's just not the case. To me, the figures that the accountant produces aren't facts anyway. We have to basically rip them apart and recreate them. So even what you might think are the facts, in our opinion, aren't even the facts. So again, it's just about being comfortable that you can say whatever you want to the valuer. As long as you believe it to be true, then let the valuer decide what they're going to do with that. So some of the key things, again, a bit of a cheat sheet you might want to keep handy, that if you're having the conversation with the valuer, with your client before the valuer is engaging or being engaged, and again, if it's a job through me, you'll have these things in the questionnaire to be able to, I'll prompt you to tell me what you want to tell me about these things. But you can see most of them are self-evident. So a business that relies a lot on key people is a risky business because it could fall over any day. So I want a high return on that business, which means I'm going to pay less. I'm going to have a lower capitalisation rate. The lack of systems and procedures means, again, the business could be inconsistent or fall over if the right people aren't running it. I'm going to pay less for that. Lack of long-term contracts is an issue. I want to see a business that's got contracted customers for a long period, as opposed to a business that has to have the phone ring today from the yellow pages to make today's sales. That's a risky business. Competition's an issue. I like a monopoly. I don't want a business that's got 5 others in the street, everything else being equal. The life cycle of the business. I don't want to invest in a business in the car manufacturing industry in Australia or in clothing and footwear in Australia for obvious reasons, because the life cycle of the business is in decline. I want to invest in an up-and-coming industry like some kind of IT sector, everything else being equal. Reliance on the current premises is an issue, especially in a lot of small businesses where you'll have the example that we come across all the time, really good location on the corner, corner location on a good street, a lot of foot traffic. It's a restaurant or it's a retail business that loves foot traffic, but there's no lease in place. It's on month to month. And at the moment, it might not matter because it's a related super fund or family trust that owns the building, so it's not an issue. But from a valuer's point of view, I can't assume that a buyer is going to get a lease in their favour, or the landlord's even going to offer a lease at all. So again, from a valuation point of view, that's devalued the business. It's a high-risk business. So if you're on the side that you want the business to be worth as much as possible, then it's in your interest to make sure there's a lease put in place for that business before the valuation gets done, and that lease is going to be in the favour of the tenant. It's going to be a 5 by 5 by 5 or something like that with minimal rent increases. Tenant owns the fit out, all that kind of stuff. So from a valuation point of view, I'm not worried about that as a risk, given that the business relies a lot on the location. The location is something that's actually in the favour of the tenant. So again, thinking that you actually have a bit of room to move before the valuation even gets done to actually influence the valuation outcome in an ethical and legal way. So I'm not talking about lying or trying to convince something of anything but the truth, but there are some things you can do that can improve the value of the business overnight, and vice versa. There's things you can do that can devalue the business overnight. The effects of government regulation. So if you're in an industry like financial planning where the government at the moment is trying to change the way they can charge their clients, Some would say that's actually halved the value of these financial planning businesses overnight. Others will still debate that, so it is still up to subjectivity. But again, I can quite easily mount an argument that a financial planner's business is halved because of the way the government wants to change the legislation or what they already have and what they plan to do in the future. So that can be a very large component. And volatility is an issue. We like investing in business with some kind of predictability. Even if a business is making good profits, if every other year it makes a big loss, it's a risky affair because it might be about to have 3 loss years in a row, which could just wipe out the business. So we like to see businesses that have got minimal downsides, even if the upsides aren't huge. Businesses on the stock exchange get punished if they're volatile. People just won't invest in them, which drives the price right down. So again, if you want to know what to argue, that last slide tells you what to argue, the kind of things to argue about, or think about providing information. So back to the process. So what we do as a value is we work out the normalized annual profit. So when I say normalized, we're looking forward. So we're looking backwards first only to work out what we think the future might hold. So if we've got good forecasts, to some extent we ignore the past altogether because an investor doesn't buy the past. It's a sunk situation. We don't get any of that. We only get the future. We look backwards only to estimate the future. If we've got good forecasts, we ignore the past. If we don't have any forecast, which is almost always the case with a small business, they can't afford an accountant to do forecasts. They don't know enough about their own business to forecast the profit. We have to go off the past, but we adjust the past to make it future looking. So we normalize. So we take out things that weren't necessary or that are one-offs, and that's what normalization is. So again, we can have arguments about the travel expenses that for this Chinese trip were actually necessary. Yes, they went over there and looked at a factory, but they didn't end up actually using that factory in manufacturing, and it looks like it was really a bit more of a family holiday. There's an argument to take some of those expenses out. So we'll talk in a minute about the kind of things we add back. But that's what normalizing is. We're not just taking the profit. Profit and loss is done generally for the tax office. We have to recreate that back to what is a real profit ongoing for the business. We then look at the estimated required rate of return. So once we've looked at all the risk, we're then thinking about, as an investor, or from the perspective that we're valuing this, what are the risks and how critical are those risks and how much return would I need? And again, that's subjective. Now, really importantly, this is where we need to think about, and again, the report we critiqued today, done by a non-accountant, had made a massive mistake where they assumed you value the business, the first two things, and let's assume they did those first two things correctly. They worked out the future profit. Let's say it was $200,000. They think it's going to make $200,000 for every year between now and infinity. Okay, that's fine. And let's say they worked out a 20% rate of return, which we now know 1 divided by 0.2 is 5. That's a 5 times multiplier. Okay, 200,000 times 5 is $1 million. Let's assume we're happy with all that, and it's $1 million business. Well, what do you get for your money? And the thing goes that you get everything necessary to run that business. Okay, so what does that mean? What do I need to run a business? Well, I need the equipment. I'm going to need the intellectual property. I'm probably going to need a level of accounts receivable and stock and trade creditors and employee entitlements and probably a bit of GST debt. I need all those things ordinarily to run the business. So they all come with the business. They don't get adjusted on top. So the classic mistake made by people that don't do this a lot is they go, well, value the business and then add stock on top. It's a massive, massive mistake. And again, do a Google search. It doesn't take you long for people to see proper valuers, basically saying that be careful to make sure you don't add it on top. But you still see people arguing to the blue in the mouth that you have to add it on. It's just wrong. And the way I explain that is if you went down to a bank and said, well, here's my $1 million for this investment, you're going to give me an interest back, thanks for that. And they say, great, but before we pay you any interest, you have to invest in $200,000 stock. You're going to say, well, that doesn't make any sense to me because now it's a $1.2 million investment and my interest is now a different return as a percentage. So what would you do? You'd actually reduce what you're paying for the business or paying for this investment by $200,000 so that once you paid for stock, you paid $1 million in total. That then makes your rate of return work again. So it's the same with the business. When we've worked out it's worth $1 million, we've worked out that we're not going to pay any more than $1 million. We pay that and we start making the returns. So if you have to buy stock on top, then suddenly your rates of return change. So you get everything necessary. So I'm labouring this point because it's something that, again, a good solicitor that knows enough will say, hang on, why have you added these things on? Unless we're going back to a liquidation value, we're just adding up the assets and subtracting the liabilities. That's different because we're not talking about business value as a going concern. We're just adding things up and subtracting debts. Okay, different story. So there's a lot of confusion around there. And again, a good question back to the value is, why have you added those things on? Does that make sense? Is that what you should have done? Have you included the debts? Just good fishing questions just to see what the value has done. But on top of that, then we look at, there must be excessive things. Sometimes there's things we add on. We'll talk about that in a minute. So some things we include in that $1 million valuation, and some things we adjust, add on, and subtract. You just need to have your thinking cap on when you're reviewing that, because you're seeing a lot of mistakes out there at the moment, and it can make a massive difference. Okay, so when we're looking at the profits, what are we doing? Remember I talked about normalizing. So we're adding back. What does this mean? We're adding back and then we're taking off. So we're looking at expenses. We're saying some of these expenses aren't real. We're going to pretend they didn't happen. So the first thing we do is we take out interest. We take out interest because that's not anything to do with running the business. That's tied into the debt. And one of the things we do in a valuation, we assume there's no debt to start with. We subtract the debt later. So anything to do with debt, in this case interest, has to be excluded. It's a whole day session to explain that in more detail to understand it, so just go with it for a minute and just assume what I'm saying is correct. So we take out interest all the time. Depreciation we almost always take out because it's only a tax entry. It doesn't actually correlate to cash. And again, all I'm worried about as an investor is show me the money, show me the cash, all these other non-financial benefits that are real to me. I don't care about tax entries that are done just at the tax office. I take out the payroll to owners and associates, all of it. I take out wages, salaries, superannuation, bonuses, allowances, directors' fees, consulting fees, and sometimes you can't find those. You've got to dig to get them out, but you take them all out because nobody's ever paid a market rate of salary in a small business. It just doesn't happen. So in the next step later, we pretend we're replacing that person with a market rate. So in this step here, we're taking it all out. Again, the thing we reviewed this morning, they'd made no adjustment for that. I just can't believe why not. Excessive or artificial expenses, so that trip to China, the telephone expenses, motor vehicle expenses, are any of those not really needed to run the business? If so, we can add those parts back out. Sometimes we'll see maybe 20% of the telephone expenses, half of the travel. There's no rule of thumb there. It's just a matter of asking the right question. So in the questionnaire, I'll actually say, tell me, this is between you and me, not the taxman, but are any of those telephone expenses not really required to run that business at the current level? It's amazing. People will actually tell you the truth if you ask. Well, at least I assume they're telling the truth. You can never know. And discounts given to related parties. So anything to do with a related party transaction, we try to bring that back on foot with what would commercial transaction have looked like. And then we were deducting things, so effectively adding extra expenses to make the profit come down. The hypothetical value of the owner's effort. Now, this is always a contentious issue because what does it cost to replace this owner? Are they a genius that's irreplaceable? Do you actually need a genius to run this business? Why this makes a difference. So let's say we could replace this person on someone with an award wage at $50,000, but someone's saying, well, hang on, this person could command a $150,000 salary if they work for somebody else. Now, the reason this is an issue because there's a $100,000 difference between those two adjustments, which means everything else being equal, there's a $100,000 difference every year in the profits. And again, saying we've got a 5 times multiplier, that's a $500,000 difference in valuation. So this business could be worth, in theory, nothing or $500,000 because of that argument about what does it cost to replace what this person does. So this is not spare change. This could be, assume this is a small thing. We've got a house where there's equity in the house of $100,000. There's a car at $20,000, and then the value of this business, it could go from nothing to $500,000 based on this one issue alone. Do you think this is an issue that needs to be done properly? And again, too many solicitors that we're seeing just don't even want to get engaged in this. It's the kind of thing as a value. I look forward to this conversation after I have my judgment and produce the report and explain my assumptions. I look forward to that conversation. Other people might have alternate views. Because at the end of the day, I want to get to a figure that everybody's comfortable with. Because if we can do that and move on, then there's and everyone understands the outcome. You don't have the issues that you have that when everybody just thinks everybody's trying to be partial and have one side of stuff. So we want the best correct outcome, but we want everybody to understand enough about what to argue so everyone can have the intelligent conversations about these things. So again, you need to know enough to ask the question: is what have you factored in? Can this person be replaced? Because we're not saying the person's not a genius. We're just saying, do we actually need a genius to run this business? And they're two different things. We look at expenses missing or under-recorded, so that retail or restaurant on the corner shop with no lease in place because it's a related party that owns the building, well, that's fine. At the moment, the profit and loss is $100,000 profit, but there's no rent. What if the rent should have been $80,000 at market rate? We've only got a $20,000 profit, really. So again, there's an $80,000 swing, which could be a $400,000 difference in the valuation just because there's no rent recorded when there should be. So again, one little thing in isolation can make a massive difference. So let's keep moving. So again, I'm just trying to show you there's some of these little things that might seem, looking at the financials, if you just accept the financials as right, you're making a big mistake. Financials that I personally prepare for my clients are wrong. I'm telling you that. I like to think I'm a decent accountant. They're wrong because we do them for a particular reason for the tax office. I'm not saying we do anything illegal, but we do them a particular way because the tax office allows us to do it that way, and we're not paid enough in terms of scope to do full reporting financial statements for every client. So you have to go on assuming that even if the accountant's a good accountant, the figures are still wrong. Okay, so again, some accountants get their back up and some valuers sort of get a bit put off when you say the accountant's wrong, but at the end of the day you have to go in assuming that, and this is an accountant telling you that. So we're looking at, we've normalized the profits now, we're going to looking at the return, thinking about, for this annual return, who might buy the business if that's what part of the scope? What risks would that particular buyer see? How critical are those risks? And therefore, the thing we're trying to get to is how much return would be needed to compensate for those risks. If I know I'm happy with a 6% or so on a term deposit, how much return do I want for this risky business? How risky, are the risks? How critical are those risks? So it doesn't have a lease in place. Well, who cares if it's an online business? It probably doesn't matter. So it's not just about does it have a lease in place. And again, you'll see people that do a lot of sort of property stuff and they're just worried about the lease. It's an online business trading out of someone's bedroom. I don't care because it could trade out of anybody's bedroom, which it would make the same profit. So even though it's a risk, it's not a risk that's going to make a difference. So again, it's not just about have you ticked off enough risks? Do those risks even make a difference, and why? And again, a good valuer will be able to articulate in everyday language why they've punished the business's value because of this issue. Why does it matter that the business doesn't have long-term contracts in place? Why does that matter in this stage? Why does it matter if the business has only got one customer? Some businesses it doesn't matter because there's such a tight contract the customer can't leave, but businesses with one customer with no ability to get any other customers with only a month-to-month deal with that customer, that's a huge issue for most businesses. But it depends. You need to look through the face of it and actually go down to what does it actually mean. So again, let's assume we'd value the business $200,000 profit going forward, or cash flow going forward, 5 times multiplier just to pick a number, $1 million. So we get all the things necessary in that $1 million. So we get all the things you're seeing here. So these are the things I need to run a business. I need accounts receivable at an ordinary amount. So I don't need $1 million worth of accounts receivable. I need some at an ordinary amount. So I'll get whatever we deem ordinary. Inventory, accounts payable, employee entitlements, equipment, ordinary taxes, which generally are sort of currently due taxes and BASs and that kind of stuff. I get all those things. So to give you an idea how this works, so we add these things up and say, well, there's $800,000 worth of stuff there that I need to run the business based on our best guesstimates of what the balance sheet says about these things. I value the business in $1 million. Well, how are they different? Well, the difference is goodwill. And this is the only way to calculate goodwill. So I've calculated the value of the business. I've worked out I need these things with it to run it. I've worked out the value of these things separately very quickly, and that's $800,000. I've valued it more than that, so the difference must be this goodwill. And that's the only way to calculate goodwill. There's no formula for calculating goodwill. Again, you see other people coming out, well, goodwill is get the revenue and times it by a number. Like, it just doesn't make any sense. Often you'll have negative goodwill, which means we've added all these things up, they're worth $800,000, but the value of the business was $600,000. What happens there? We've got negative $200,000 goodwill. It's actually, it's like if you watch the Gordon Gekko movie, it's like, well, we just strip this business and sell it. It's worth more than the current price is, and that's the theory. It happened with the one we were reviewing this morning. So the value of the business as a going concern is not worth as much as just buying the company, stripping the assets, paying the debts. So we do revert back to add up all the tangible assets, take off the debts, and that's the value of the entity. We call that a net asset valuation as opposed to an income method valuation. And it's surprisingly how often that happens because so many small businesses are so badly run, they don't actually make a profit even to cover the owner's wage. So we are coming back to this basis, but you can't just jump straight ahead to valuing the assets individually because you don't know you have to do that until you've worked out it's not worth anything as a going concern. So you still have to do a going concern valuation first. And importantly, you get all the intellectual property rights as well, unless that intellectual property is sort of owned by the entity and not used in the business, and it's got a value in its own right. So then we make adjustments to that figure. So like I said, the $1 million, you get everything on that previous screen, but only the ordinary amounts. if the current level of accounts receivable are at a high amount that are extraordinary, then that extraordinary amount above and beyond what's ordinary is then added on. So we don't add on the whole accounts receivable, just the amounts that are extraordinary. Because remember, what we're doing here in the case of a family law valuation or any kind of litigation is we're looking at the value of the whole entity, not just the business. So the entity, if you look at a company owns the core business but also owns these other things, and you only get these from the balance sheet. So the excessive amounts of those things on the previous screen, plus bank accounts, loans, land and buildings, and anything else that wasn't implicitly or explicitly included in that other screen, we add that onto the value of the business to get the value of the overall shares. And again, if you're not looking at the balance sheet, you're only doing half the job. To give you an idea of what a full valuation looks like, and to save time, I'm going to email everybody a PDF of one we've done before. We're taking out the names to protect the innocent. If you're watching this live, you'll get the email. If you're watching this as a video, send us an email. We'll send you a sample. But it'll basically show you that how the report's set out, the kind of information we provide, and importantly, from a legal point of view, you have an executive summary telling you an overview. Then the very next section in our report is called an important valuation commentary, and this is your hint. This is your ammunition. This is the important stuff that could probably be argued a different way. So this is your ammunition. If you're not looking and reading through a report to think about what are some of the things I could argue, what are the things that the valuer wasn't certain about, and a good valuer tells you what they're not certain about. They don't pretend they know everything. And again, they're the things that you know as a solicitor. Okay, well, if I know they could have argued about, are they going to make a difference if I argue them? And again, how does this actually improve your client situation? Well, if you can go back to your client and say, look, there's some things that we could argue about. It's going to cost a little bit of money to send letters back and forward and have phone calls, and get your client to make the punt. You know, do they want to spend money arguing these things? So it gets in a really good situation for you where you're asking your client for money, and it's their decision about whether they want to spend this money based on what any likely results might be. You're not going to get that buyer's remorse, and you don't have to take the punt about whether these things are worth arguing about. As a solicitor, you're getting your client to actually give you permission to spend that money arguing, and because you sort of know what you're arguing about, you can quite easily do that. You know, have that conversation with your client. Okay, so far we've talked about financial value. Now we're going to talk about strategic value, and to make it interesting, we're going to make it about a legal firm. Okay, so again, I did this session face to face with a room full of lawyers last week, and it just blew them away. It made them a bit excited about what the firm might be worth, but also made them think that there is no such thing as just tell me what a business is worth. It depends on perspective. So let's say that the to you column is your firm as you would see it. So at the moment you're making $1 million revenue. A lot of that revenue is sort of consistent stuff, recurring stuff, and referrals that come in. So in theory, next year you should make about the same, at least. We looked at your expenses, and after adjusting, artificial things, and after replacing the partner with the salary, there's $900,000 worth of, hypothetical expenses, and that means the real profit is about $100,000. And that, again, that's after paying the partners the salary. So it's $100,000 in investment return. We've looked at all the risks, and we think we're happy with a 25% return, which is a 4 times multiplier. So we've got a $400,000 valuation. Again, how do we work out 4? 1 divided by 0.25 gives us 4. Multiply the $100,000 profit by 4, $400,000. But then that's to you, it's worth $400,000. But to somebody else, this other to them column is a national firm that's going bolting on all these small firms. You'll see a lot of big firms doing that at the moment in your industry and in mine. And they're looking at your business and going, we're quite happy we're going to keep making that revenue, but we don't need all your expenses. We don't need all your staff. We don't need your location. The staff we are taking of yours we're going to put into one of our offices. We don't need all your typists. We don't need all your machines. We're more efficient than you. We've got procedures. They think they're only going to have to actually spend $600,000 to earn that $1 million. So to them, they're going to have a $400,000 profit. So interestingly, even though the risks can be assessed the same, we've got a 4 times multiplier on a $400,000 profit, which makes a $1.6 million business. So straight away, this should knock your socks off, because this is the biggest problem we have in using comparable data with valuations. Let's say that you did sell your firm for $1.6 million. Does that then mean that I can go along and value every other firm at a 16 times multiplier? Because I don't know how these buyers assess your profit. All I know is that, to me, looking at your figures and making adjustments, you've got $100,000 profit. I know that someone bought it at $1.6 million. Therefore, is it natural then to say that it sold at a 16 times multiplier? Well, it obviously didn't. It still only sold at a 4 times multiplier. But I'm never going to know that because I don't know how the buyer saw the profit. So whenever you see, even if there's a similar business down the street and you know what multiplier it's sold at, based on the sale price less what last year's profit was, that has got nothing to do with how the buyer valued the thing. Okay, so this is, again, just an example why comparative rates are very dangerous to use, because, and again, it doesn't mean in this case that someone would actually pay $1.6 million. They only would if there was multiple people in their position. So we had a few multiple national companies and they all knew of each other and there's a bidding war. Okay, then we might get close to the 1.6 million. But really, if there's only one buyer, do you think they're going to pay any more than $400,000? Well, they've got no reason to pay more than that, because you've got no other options anyway. You'll either have to accept somewhere near $400,000 or just not sell at all, because they're certainly not, even though it's worth $1.6 million to you, they're not going to reward you for that. So again, I'm just trying to get in sort of into the world of business values. It's not an exact science. You really need to think about what are the big issues in the big picture. And again, I could argue this business is worth $1.6 million. Doesn't mean anyone would pay that for it, and it certainly doesn't mean that's how I'd value it for family law purposes. Okay, so for family law, what are the key issues? Is it market value or value to owner? So if you look at the case law, most of the time market value is still used because people just don't have enough time, or don't know what to argue. But the big cases where there's a lot of money spent, they use this definition called value to owner, where they're basically saying even if there's no market value, or the market value is high or low, we're going to ignore that to an extent and go about what is it worth to the current owners, which opens up a whole can of worms about what is it worth to the current owner. So again, you need to think about what does that mean? Is there a difference? And that's fine. Again, the valuation I critiqued this morning, they said market value is nothing because no one would buy it. And I said, well, yep, probably agree with that, but it's not actually relevant for the case. So if you read that and you believe it and go, yep, and you agree with that too, and then take the number, put it in the drawer, and move on, then you've missed an opportunity. The assumption is that the other party, you've got to go on assuming that the other party's solicitor knows a little bit about this stuff, which is probably not the case, but you've got to assume they do. And if you don't even engage in the process, then your client's not going to obviously get the best outcome. Is an unsellable business still worth something? In a commercial sense, generally no. In a family law case, it can. Is a minority interest valued proportionately? In a commercial sense, 20% of the shares in a business is usually worth less than 20% of the business, because as a minority, you can be disadvantaged. So that 20% share could even be further discounted by 50% in a commercial sense. But in a family law case, often we're asked specifically to value them at face value. Don't discount them for a minority interest. Does personal goodwill have a value for a commercial situation? Usually no. For family law, it can. Does a past informal purchase offer count as evidence? So if someone sent us an email 6 months ago offering to buy the business, does that count as evidence? Well, it does count as something. The degree to which we rely on it depends on how serious it was, but it's certainly something you should be putting forward. What happens if a spouse runs down the business, and what happens if income is alleged to be missing? So probably more than half the occasions we do a valuation for a very small business, these issues are raised. Again, I keep bringing it up because it was a classic one this morning. The income had gone from sort of 500, 700,000, 900,000, and then this year it's gone to 300,000. That's the income before expenses. So the income has dropped by 2/3 the year before the divorce. Now, is that deliberate? I don't know, but it's something that needs to be thought about. Why has that gone down? We need further explanations. And one party, if they're smart, they're going to argue that the husband deliberately did that. It seems something worth arguing about, and probably they'll argue that even those numbers there aren't real anyway, because the husband wasn't declaring all the income. And again, there's ways that we've got as a valuer to approach that. We can't always forensically test it, but we can certainly say, well, if there was missing cash income, here is the difference in valuation. So if we can say for every dollar of missing cash income, add X to the valuation outcome we've come up with. So that's actually successfully happened in the case we've done. It got settled, it didn't go to court, but we said, look, here's the valuation as is. For every dollar of missing cash income that the parties can agree on, add X times that number to the valuation outcome, and they can go away and they can settle on a value. So it's just about, okay, I think there's $50,000 missing cash income, you think there's no missing cash income. Can we find a figure somewhere in between, multiply that by the number Trevor's provided, add that to the value of the business, or where we go, and then you're back on the big issues like custody and stuff. And again, these evaluation things shouldn't drag on for months like they seem to. So given that we don't want to spend months doing these things, we want to just get the job done, get a result, move on, have everybody happy enough. No one's ever going to be totally happy. That's not the goal. The goal is to be able to move on. So what we've basically invented, we haven't seen anybody else offering, is this pre-valuation estimate level. So you won't see it offered by anybody else. It's due to popular demand. So people come to us and say, what's the cheapest thing you can do that's good enough that can be tabled where we can use in settlement, or we can use to decide whether someone's offer is good enough. So we've come up with this method. So it's a very limited report. The front cover says this is not a business valuation, and it's for a very small business. You're looking between $1,200 to $2,500, so it's very affordable, and there's really no excuses not to get some kind of valuation. So if you're going to have arguments about estimates, great, but don't do it without at least having this valuation done first. Then you at least know we're going to tell you what kind of things are worth arguing about. Number two is a limited business valuation. This is the level we'll start signing an affidavit for. And, really, that's the thing we do. If it's going to go to court, you're going to need this level. You don't necessarily need to start at this level. You can start at an option 1 and upgrade later and just pay the difference. This is typically about double the price of an option 1, and we generally do a fixed price on that. And option 3 is a full valuation. The difference between this and option 2 is we do site visits and a bit of forensic work on the option 3. But for most cases, it's cost prohibitive. It will generally start at about $5,500 and go higher depending on the size of the business. So our recommendation most of the time, start at an option 1 and upgrade later if you need to an option 2. If you want an affidavit, you're eventually going to need to get to an option 2. But usually an option 1 for a case that's going to settle outside court for a small business is usually enough, and you don't need to spend any more money. So what are these top 10 mistakes or missed opportunities that we see? So wasting time and money arguing about estimates. So often we'll do a quote for somebody, for the solicitor usually, and then the solicitor will say, that's great, we're just going to argue about some estimates for a while, we think we can nut this out without a valuation. And then what happens, 12 months later we get a phone call saying the court case is next week, we'll now need that valuation please. And obviously we're rolling our eyes going, it's a couple of things going on here. A, you haven't given us enough time. If we want to do the job, we like you, we think you deserve it, we might grumble about it, but we'll get the report done in time, burning the candle at both ends to getting it done, but we will do that. But what's really happened there is your clients paid probably a hell of a lot of money in legal fees for no result, arguing about things that were probably never going to be agreed upon, that probably weren't the right things to argue upon anyway. So again, of course I'm going to say the minute you think you might need to get a valuation, hand some money to a valuer. Yeah, of course I'm going to say that, but in hindsight it happens far too often that everybody goes and argues and spends money on estimates only needing a valuation later. God forbid you actually agree on the estimates, with those estimates anywhere near what the business is worth anyway. So again, that's why we've invented that cheap and nasty level. So for a very small investment, the parties can at least, whether it's one party or both, can engage us to at least find out what we think it's worth ballpark. And that can then at least, if you're going to have arguments, argue about those things. And again, of course I'm going to say that, but something, take it with a grain of salt, but really think about the minute that you're probably starting to argue about estimates and you're not sure about whether it's ever going to be solved or your estimate's in a ballpark figure, that's the second where you need to engage your valuer, whether it's us or somebody else, you need to get somebody in. Number 2, thinking an expert must obviously be jointly appointed. It's probably about 50-50. Half the time we're not jointly appointed. We're always independent. We don't mind who appoints us, but whoever appoints us gets to see the final report and gets to give us information. So, but we'll have situations where we'll be appointed by one side, and then later we'll be jointly appointed, and both parties are happy with that because we've been totally above board and transparent at all times, and they've checked their references and they're quite happy then to it. And often we can do that and be very cost effective by not needing another valuer. We can effectively be engaged by both parties jointly after. Again, a good valuer doesn't care who engages them. It's the same result either way. Number 3, not getting a rough proposal first before escalating. So don't go and spend $20,000 on a valuation if you're not sure if you needed one. And number 4, engaging a valuer to do more isn't actually needed. Don't let the valuer tell you they need to do a site visit on every occasion, because in my opinion it's not required on most occasions. Ask them what is the minimum you could do to give us a figure and what the business might be worth, and then suggest to us what extra work you might need to do. And you'll find some valuers going, no, I can't do that, I've got to charge the $10,000. And that's how they want to charge you. It's not necessarily what you need. So again, you're the solicitor, you're in control of these things. You're the one engaging the valuer, with or without another party helping you do that. But don't let the valuer dictate terms for you. There is an open marketplace. You're free to engage whatever value you want. And if you don't think the valuer is going to give you the best result or the best value for money for your client, then you are free to get other quotes and talk to other valuers. Number 5, using a value without qualifications or independence. So again, from today, I hope you can see that you need somebody with a finance background. It's just not going to work if they don't. And you can't use the current accountant because there's a perception that they're not independent. Because the accountant genuinely knows one party better than the other. One party's been coming up to sign the tax returns every year. They probably haven't seen the spouse very much. There's definitely a conflict of interest there, even if it's only perceived. Number 6, not understanding that business valuations are subjective. So as you can see from today's session, nothing is a fact. Nothing's black and white in a valuation. That's why we don't have formulas. That's why we don't have software. We have to think our way through these things. But again, everything we do is subject to criticism and critique, and a good valuer encourages that, and that's where you've got to have an opinion. So number 7, not understanding fundamentals to have their own views. I want you as a valuer to have a view. Okay, so I'm a valuer, you're a solicitor, I produce a report for you and your client, have a view. Number 8, not advocating to the client's benefit in the instructions. So don't ever just hand the financials over and say, give me the valuation. If the valuer doesn't give you a questionnaire, then it doesn't matter. Come back and propose things the valuer needs to know about. A good valuer will give you the questionnaire and ask you the things that they might need to know about. Write one sentence, write an essay, we don't mind. If you give me a 3-page diatribe on why you think the business relies on the current owner, I'm going to read it. I might not agree with it and might totally disregard it, but I'm going to read it. It's up to you, again, to go to your client and say, look, there's an argument here. It's going to cost X in my time to put this information to the value. Do you want to fund me to do that? Would you like to put some money in trust? So again, that's not the valuer getting paid more money. That's you getting paid more to do a better job or to be more engaged in the process and letting your client be aware of the costs and benefits of that before you invoice it, which importantly, you don't get any buyer's remorse. So number 9, not taking time to understand the arguable assumptions. A good valuation report will say, and mine included, will say, here's all the things we weren't sure about that could have made a difference. That on a platter is information for you to say, hang on, there's some ammunition there. If we're going to argue about something, we've now been given a narrow scope of the things worth arguing about. And number 10, not insisting on a fixed price in advance from the valuer. Too often we see fee estimates where it'll be, we estimate the valuation fee will be in the vicinity of $5,000 to $7,000. And it so happens that 3 months later, an invoice comes out and it's $12,000. Again, I get a laugh in a live audience when I say that because it happens all the time. And why does it happen? Because there's unforeseen circumstances. But what happens that you see over time that every job they do has unforeseen circumstances. So you really could ask yourself, if every job has unforeseen circumstances, are they really unforeseen? Is it just because they're inefficient? Or they're actually being tricky and deliberately offering a low price just to get the job. So I think the onus is to come back on them and say, look, just like we do, give us a fixed price that you're going to fix within a given scope. And if you're not sure what work you've got to do, tell us what you are sure you've got to do and fix that price, and then come back and ask for more money if you want to do more work and give us a chance to say no. And that's what, people come to me and I think that's the ethical thing that I should be providing them. And I think you should demand the same of others, because then at the end of the day, if the valuer goes and gives a ridiculous bill to your client that they get upset about, do you think they get upset with the valuer? No, we don't. Valuers don't hear about it, you hear about it. So at the end of the day, you're the one that cops the grief as the solicitor. You're trying to maintain the best outcome to the client. If they pay a cent more than they have to whether it's a valuer or anybody else in the process, that's reducing the asset pool, and that's actually getting a worse outcome for your client. So you need to think about it and insist on the fixed prices. And if they don't want to do a fixed price, you really got to think about why don't they want to do that. So given that it is all about efficiency, it's about getting things done quickly. And I see my business as a resource to the solicitors. And again, I don't care if one solicitor engages me; I'm still independent, and you get the same result as if jointly had it engaged me. But to make the process easy, we've got a system where same day we do quotes. So if you ring us on that number, give us a little bit of information about the business. So all I really need is the revenue for the last 12 months, how many staff the business has, what industry it's in, and a rough estimate of the assets used in the business, like equipment and cars. If you give me those figures, in about 2 minutes we can give you the fixed prices for three different options over the phone, and about 15 minutes later you'll receive a PDF with a fixed price engagement letter. So again, from that day, you could give that to your client and the other party. You could have it signed off, and we could start the valuation process that day, which basically means we would then issue, once we've received confirmation to go ahead, we'll issue the questionnaire to one or both parties to start gathering the information, start mounting your arguments. And once we receive that information back, within 1 or 2 weeks you'll have a final report. Always within 4 weeks, but often within one or two, depending on the size of the job. So again, there's no reason why this has to take weeks or months to get started. It certainly shouldn't take months once it's been started. We do find at the moment some other valuers are taking 2 to 3 months before they'll even start, and in some cases a month just to quote it. So to make it easy, if you want, you don't have to do this, but we've got a site just for solicitors, just for divorce valuation quotes, called divorcevaluation.com.au, funnily enough. And if you go there, you can log in for free. The only reason we get you to log in so we don't have the valuers using this as their quoting system, but you can go in there, self-service, answer those questions yourself, and get those 3 prices for the client. Don't have to tell us who the client is if you don't want to. If you want a fixed price written engagement, you then just have to give us the client's details, press a button, and then we'll email you back same day a written engagement letter. So there's no excuse for not knowing what the price would be. Even if you're not sure if you need a valuation, get the price, think about that. Is it worth it? Is it not worth it? Give us a call, talk about some of the pros and cons of getting a valuation done. Or if you've already had a valuation done, just give us a phone call, and we'll do a free critique of some of the methods or something like that, which is we're doing that quite often at the moment. We're quite happy to provide that as a service, even if we don't get any work out of it, because swings and roundabouts, we're building relationships with our referrers. So I'm going to leave it there. That's enough of the shameless pitch. And again, I do encourage everybody, we're very approachable. If you've got that niggling issue in the back of your mind, give us a phone call or an email. If you've got a report done, you're just not sure whether it makes sense, and with your client's permission, you want to flick us a copy, and we'll give you a 15-minute critique of it for free. Or if you want to engage us for a very, very small job, we value businesses all over Australia, anything from turnover of $20,000, one we're doing at the moment, $85 million turnover, all different industries. Our process is generally the same. Obviously, some different businesses and different revenues have got different amounts of work involved. That's why prices are different. But we have obviously, as you've seen today, it's the same theory. We're trying to work out what do we think this business will make in the future in terms of cash flow, and what are the risks in this business. So as long as we keep bringing it down to that, we keep having intelligent conversations with our solicitors, our referrers, and your clients, then we'll make sure we get the most, the best outcome that we can explain to others, everybody can be happy with or move on with, and and get on to the next job. So again, I do appreciate your time. We will be emailing everybody that's on the live webinar a copy of the slides and a copy of the CPD certificate and a copy of your sample report. And don't be a stranger. Please get in touch, and we look forward to talking to you when and if the need arises. Bye for now.